Good morning. So let's talk about business and economics. This is chapter 1. And I promised there wouldn't be a lot of lecture, but this is sort of foundational because the case studies and the quizzes, everything really sort of builds off of this one chapter, right? So let's start. So what is a business, right? It's very interesting. On campus, we get a lot of really interesting answers, and but in a nutshell, a business is an enterprise that develops a product or service, and they deliver it to a group of customers. That's it. That's what a business is. And so, if we use that definition, Chabot College is a business, right? We develop a service, our education, and we deliver it to a group of customers. You. And although there is some argument that the student isn't really our customer, that our real customer are the employers or society. That is our customer. But it depends on your perspective. At the end of the day, my job is to deliver something to my students that's going to help them either find a job or grow economically or grow in some form or fashion. But it's an enterprise. It delivers a product or service. So what are the differences between these two, right? What is the difference between a product and a service? Definition is pretty easy, right? A product is tangible. You can pick it up, you can hold it, you can smell it, you can touch it. So, in the product category, because of that smell, touch, feel, restaurants are going to fall into that. Services can only be felt but not touched or seen. So, what are some examples? Pretty easy. Your smartphone. I'm sure you're watching, the majority of you are probably watching this lecture on your smartphone. And maybe you're using your earbuds. Those are going to be products. The services, the Wi-Fi that you are paying for. You can't smell it, you can't touch it, but it is something that's provided to you of some economic value. So that's a great example, right? The Wi-Fi, your internet. Something like, there's always a debate. Is McDonald's a product or a service, or is it both? Because one is delivering you a product, but part of that product is a service of the preparation of the food. So, it's always up for some really interesting debate. And so, the 3,000-foot view of business, what's the purpose? People are you're going to hear, purpose of business is to make a profit. But is it really? And, businesses may start with the objective that it needs to generate some sort of economic value, and or it's a hobby, right? If it doesn't make money, if it doesn't generate a profit, it's a hobby. But what if a business's exclusive purpose is, regardless, is I just need to make a profit? Well, then there's going to be some problems, right? Because maybe they're not going to be taking their customers' needs into account, or they're not going to be focusing on the quality of product, and which means that their ability to generate a profit diminishes. So I have a different perspective. The purpose of a business is to deliver value to society, and the reward is a profit. So if we look at a company like Apple absolutely views that, right? They have a very intimate a view of who their customer is and what they must do in order to be able to serve their customer. Now, if Apple didn't have that perspective, and there's been probably 100, 200, 500, 1,000 companies that thought they could take on Apple, and except that they didn't have their view on creating value that Apple did, or companies like Apple. And so it's to deliver value. Your reward when you do that is profit. If you don't do that, there's no reward. And those companies go out of business. We get companies that start and fail all the time. And they're going to come up with a bunch of reasons, but a lot of it has to do with the fact that they just weren't delivering value, right? And so here's the million-dollar question. And this is important because a lot of what we're going to be talking about in future case studies has a lot to do with this. So what is profit? Profit is total revenue minus total expense equals profit or loss. So if your total revenue is $1,000, your expenses are 800, all expenses, all in, you made a profit of $200. If you have total revenue of $1,000 and your expenses are $1,200, now you've lost money, you've lost $200. And there's nothing you can do to make that up, right? It's always interesting. There'll be a case study that we have in a few weeks that talks about the fact that each unit of a product that you make loses money. And students are like, well, we could just make it up in volume. It's kind of like, no. Every unit that you sell, you're going to lose $2.96. If you sell 100 units, you're going to lose almost $300, right? If you sell 1,000 units or 10,000 units, it just the loss grows, and it's not like you could sell more to get out of that loss. And so you got to make sure that your expenses are less. Now that was the simple version. Now this is really, in my opinion, the most important part of this scenario. There is this cost to develop the product. So think Apple. Apple's got their all the pieces that it takes to make the iPhone. We'll talk about that in a second. Or McDonald's, right? They're going to sell you a burger for, I don't know how much are their burgers now, a couple bucks, $2-3. They're going to sell you a burger for $3, but they've got input costs, right? They've got what we hope is beef and some cheese and some onions and ketchup and mustard, all those pieces. And then they've got labor that goes into making that. That is cost of goods sold or cost of material. In some cases, it's cost of sales. You're going to see a lot of technology companies that have cost of sales. And because they sort of, they've got other things that maybe not have hard costs. And we'll get into that later in the semester. But when we have revenue minus this cost of goods, the cost of delivering the product, creating the product, that equals gross margin. Gross margin, in my opinion, that's the most important number. Revenue is great. Revenue always sounds fabulous. But if your cost of goods are too high, you're not going to have enough money to run the business. And at the end of the day, gross margin is the money we use to run the company. We don't run our company on revenue. We don't, because we have to pay for the product. So if somebody gives me $1,000 and I've got to go spend $1,200 to go build that product, now I've got negative $200 to run my company. So this gross margin number really is a critical piece. We've got that project too in a couple months from now, when we're looking at the financials of 3 publicly traded companies. We're going to be looking at that gross margin, and you're going to really see the difference between companies that grow their gross margin and companies that don't, and how that impacts overall performance. And so gross margin really is a super important piece. You're going to want to remember this formula. So let's go look, what are COGS? And obviously this is an older image, but it's still pretty darn close, right? So Apple, this is the iPhone 15, 128 gig. The component costs. So all the little bits and pieces, right? They got the little, the screens and all the little things inside there and the buttons and the case, $423. The direct labor cost associated with this, $35. So it takes $35 of direct labor, right, to have this thing put together. And then they've got manufacturing overhead. And it's the cost of the utilities and the equipment, et cetera, $42. And then they've got packaging, the materials, because Apple's got the best packaging. Seriously, I bought a MacBook Air, and I was going to buy the Pro, but man, that thing got expensive. So I bought a brand new MacBook Air. My old one was, I don't know, 8 or 9 years old. And I'm still having a hard time throwing away the box because they've got the best packaging ever, right? And so $10 to do that packaging. So total cost of goods on that iPhone that they sell for $800 is $510. So if we look at Apple, you got their $799 over here minus their cost of goods of $510. They got $289 per phone in order to generate profit, right? Let's look at another scenario, right? We've got a coffee company. So we've got, we're going to sell a latte, 12-ounce latte. We've got ingredients, milk, espresso, the beans, the syrup, et cetera, whatever. We've got the packaging at a quarter. We got direct labor, which is interesting, right? If you look at the food and packaging, it's equal to the labor. And then I've got some store overhead. And obviously, sometimes it's not measurable, right? And then I've got miscellaneous stuff to keep the place clean, et cetera, et cetera. So let's assume I'm all in, call it $2.25. I sell this thing for $6. I got my cost of goods. I've got my gross profit minus my operating expenses, which is probably going to be the bigger expense, right? It's going to be the rent. It's going to be other payroll. Because in some cases, it might cost me $1 worth of labor for a barista, but maybe that barista's making 20, $22 an hour plus overhead puts me 25, $26 an hour, and they're not making 26 coffees an hour. So they may maybe only gonna make 15 an hour, but I've still got to have money to pay them for the rest of the time. It's not like they can pay them per piece. It's illegal in California. I believe it's illegal. And I got to pay people for their time, not necessarily for their output. So then what's left is my net profit, right? And so this concept of gross margin is really important because I don't have $6. So when you go and you pay $6, you're like, man, that's a lot of money for a cup of coffee. Yeah, but you know what? There's a couple bucks just to, in hard costs for that cup of coffee. I've got a student now, one of my entrepreneurship students. He keeps doing these boba and matcha pop-ups in San Leandro to Fremont. He keeps doing them. He takes buys materials, goes somewhere, sets up, and sells matcha and boba. And he sells them for like $6.50, $7 a whack. And he's always coming back to me going, "Oh, I just sold $700 worth of bobas, right?" And I'm like, "Great. What was your gross margin?" And he still gets, and he's not able to really explain it. And that's where a lot of companies run into hardship, is that they don't really have clarity on what their costs are. And so we're working with him, trying to help him get his arms around what are those hard costs. And so if we look at next, right? So we've got revenue minus cost of goods equals gross margin. Next is gross margin minus expenses. So what are expenses? Expenses are labor, wages. We got sales and marketing and research and development. We'll talk about that more. Energy, we've got taxes. You got all these other things that go into, that are required in order to make a business run. And these are really the big ones, right? Labor tends to be the biggest one. And within sales and marketing, there might be some labor. It depends. There might be some research and development. And but these are the big things. So if we take our gross margin, right? Revenue minus cost of goods equals gross margin, then we have our expenses. Boom. Then after that, we have our profit. And that's really important because we need to sort of understand how this all flows. So companies, what do they do with their profits? Right? It's always if you're a big public company like Apple, Walmart, Nvidia, investors are really, really focused. What do you do with the money? And, they distribute it to their shareholders, and they can do that a couple of ways. We'll talk about that in a second. They can retain some of it for future use. They can fund growth initiatives, right? So maybe, they want to, Apple right now is spending a bunch of money, and they made sort of a promise that for the next 3 years, they're going to have really big innovations. We know the first one's going to be the folding phone. And so I'm pretty excited to see what ultimately the folding phone looks like. And then they've got other stuff that's sort of on deck. So they're funding those initiatives, buying new equipment, right? So in a lot of cases, in all cases, Apple doesn't manufacture their own stuff. They're the designer, and they work with other companies in order to have those things built. So they're not necessarily buying new equipment. They might be buying new office stuff or maybe some equipment for prototyping. And then I joke, buy a Lambo, right? Because, if you're going to make a profit, you want to do something fun. But let's take a look at Apple. What does Apple do with their profits? And recently, this is what they did. They do share buybacks. So every day, Apple is buying its own stock, and so Apple is just constantly in the market. They're buying back their stock, and this is one of the ways that they're able to deliver value to their current shareholders. Because if I reduce the total number of shares that are outstanding, then I increase my profit per share that I own. Right? Dividends, R&D investment, supply chain and infrastructure. I think that supply chain and infrastructure numbers actually increased significantly because of the tariffs and all this stuff that's going on. They've had to rethink their supply chain. As a matter of fact, their stock was down a couple weeks ago quite a bit because their supply chain is just not functioning the way that it used to. And they're not able to get the chips, and they're not able to get the pieces that they need to put these phones together. As a result, there's more demand for the product than they're able to meet. And they're working on it. So I think they're probably spending more than their 10%. And then 10% for cash reserves. Apple's known. They've got several $100 billion in cash sitting in their accounts. And so, yeah, this is kind of what they do with their profit. So let's shift and talk about the second part of the chapter. And what is economics? And students are always going to say, "Oh, student economics is money, right? That's what it is. It's money." It's not. Economics, in the simplest term, it's choices. And the more academic description is it's how people choose to spend the limited resources they have. And so if you think about it, you have limited resources. Every day you have to make a decision how you spend those limited resources every day, right? And right now you are taking a college class instead of doing something else with your time. And because you've made the choice, an economic choice, that maybe taking this class is going to result in maybe more economic reward later, right? You're going to have more freedom later. You have more capital to make better, to make other decisions. And that's what it is. It's just choice, right? And so if we think about choices, choices are made, right? If you think about our city, let's say Hayward. Hayward gets tax revenue, and it gets some money from the state, and it gets some money from the federal government, and it gets money, and its job is to now create the best Hayward it can. So it's got to have a fire department, a police department. It's got to have a department to clean up the streets, and it's got to have a department to fix the potholes, right? It's got to have a department to help with housing issues. So if you think about Hayward, Hayward's got what some would say unlimited wants, right? We've got people that just expect the city to be able to do everything for them, right? And but Hayward has limited resources, so it's really trying to spend its money in the best way possible in order to be able to deliver value to its customers. Same thing with the state, same thing with the nation, right? And so these are, what do we do? How do we do this? And so within economics, there are several types of economic systems. So the one that we're probably the most familiar with is ours, right? The U.S. And most of Western society is capitalist, and this means that we have individual decisions are being made. There's this thing called the market mechanism, whereby the market, us, decides what gets manufactured and what doesn't, what products are made available to us and what products are not. And the way that we make those wants known simply is by buying or not buying. And so, there are going to be certain products that enter the market that don't get bought, they go away. Now, did we write a letter to somebody saying, "Hey, I don't want that"? No, we didn't. The way we communicated that decision, us as the market, we just didn't buy it. It went away. And so, as a result, capitalism, we got lots of freedom and innovation. But there's also a fair amount of inequity, and there's a lot of economic instability among certain segments of our population. That is the downside of capitalism. Not all boats rise, right? And but we have lower taxes, and so we've got a system that really rewards people that are innovative and more aggressive and more educated, and we've got a system that rewards that. And but at the same time, we do have a large, 20-30% of the population that just don't they don't even live a basic life, right? Have their basic needs met. So socialism is another economic system. Norway, a lot of the northern European countries sort of subscribe to this. You've got utilitarian decision making. So it's not the market deciding, it's us deciding. I don't decide, we decide, right? But there's also limited upward mobility. And one of the reasons is that the taxes are pretty high. And when we remove the profit motive, right? And so right now we are incented to go make as much money as we could possibly make. And in some cases, we've got, you get to a certain point where you had a certain amount of net worth, the amount of taxes you're paying is almost nothing. And the reason there's a bunch of reasons for that, but because you're no longer relying upon income, and income is what's taxed. And so within the socialist networks, there's not really a lot of incentive because the more money you make, the higher your taxes are. And so it sort of limits this upward mobility, but it creates sort of a base where everybody lives. You might have a few outliers on the upside and on the downside, right? Maybe a small handful, a percentage of people are going to live above that average. Maybe a few that live below the average. But you're going to have equity, stability, and you're going to have higher taxes. But those taxes result in healthcare and free education and a lot of support. And regardless of your opinion, right, these countries tend to be voted the happiest, right? These are the ones where people tend to be the happiest. And we've got a couple of others, right? We've got blended and we've got communism. On the blended side, we've got it's China. People are going to see communist China. China's not really communist. They may have what they call a communist party, but I got to tell you, that is a pretty capitalistic society. I've been to China several times. Every time I go there, I'm impressed by the amount of innovation. If you go look at their cars and you go look at what they're doing in AI, there is incentive. They have billionaires there now. The last time I went, I took my son, and at the time I had a Porsche, and we were driving around on a tour bus, and he was counting the number of Porsches that he saw on the streets in Shanghai. I finally told him to stop counting at 14. So there's wealth there, right? And so in this case, you've got some government and some market-based decision-making. You do have a limited amount of controlled growth, but there's more complexity, more trade-offs, right? The government at any moment can decide, okay, this is the new rule of the game. And so that creates some complexity, right? And then we've got communism and, maybe North Korea. There might be one other country that's really communist, where there is purely central decision-making. Russia, maybe, but there's still a fair amount of capitalist behaviors that are there. But there's central decision-making. Basic needs are met, we believe, but there's an overall lack of freedom. Is there a system that's perfect, right? The reality is that there's not an economic system that's pure. The U.S. is nowhere near being a pure economic system. I mean, most recently, the United States is investing in companies now, and that's very socialist, right? It's exerting control over decisions that companies can make, and that's very socialist in its thinking. So the U.S. is sort of a mixed economy. China's very much a mixed economy. There's nobody that's pure. Everybody's got an economic system that, what they're doing is they're trying to create the best environment for their people, right? And so how do you connect the dots between these things? And economics and business are absolutely connected. And when we've got good economic environments, we've got a strong economy, businesses do better. When global markets are good and we've got more international trade, markets do better. Um, that's just the way it works. When we got strong economy, things are good. When we've got a bad economy, things aren't so great. And so business and economics are intimately intertwined. And so that's what this week is. A couple of things I need you to study separately is the law of supply and demand. We will talk about that quite a bit in these case studies going forward, but it's really hard to do that on a PowerPoint. So make sure the chapter of the book you read on the law of supply and demand, you spend a little bit of time on that, because that really is how this idea of the market mechanism comes into play. Um, we we also we communicate not just whether we want something or not, but what we're willing to pay for it. And the way that we do that, once again, is by buying or not buying. And so the law of supply and demand tells us a couple of things. One is that when prices go down, demand increases. And that happens for a couple of reasons. One is that more people are able to afford it. And whereas, if this product is super expensive, I might not be able to afford it, but the price comes down, I might be able to afford it now, right? And two, people that thought they wanted it but didn't want it because the price was too high. Now they're like, okay, I wanted it, but now the price is lower, so I'm able to attract a new markets, new customers, and bring customers that I was unable to get before into and buy the product. The other side of the law of supply and demand is that it communicates to suppliers, hey man, people really, really want this. And so maybe I need to dedicate more resources as a business to developing more of these products. But I can't do it if the price is too cheap. So if the market communicates, look, we want this and we're willing to spend money for it, then a supplier will manufacture more of it. However, if we say we want it, but we're not willing to spend a lot of money on it, then at the same time, the supplier is not going to go manufacture a whole bunch of these. There's no incentive for them to do that. So this law of supply and demand, these lines illustrate, they fight back and forth. And pricing plays a huge role in this, because what we're willing to pay will ultimately determine how much is available. Let's go back and use Apple. Apple's got extraordinary demand for their phones. And as a result, they're able to command a pretty high price. I think the latest one's $1,000, right? And so they're able to command a pretty high price. So the market is communicating we want it and we're willing to pay for it. And so Apple's like, we're going to go manufacture some. Of course, the problem Apple's having now is resources. And we've got some global markets issues because we have government policies that are not exactly making it easy for Apple to do business in other countries and raising those costs of doing business in other countries. And it's just not easy enough to say, I'm going to go manufacture in the US. And there's a bunch of reasons for that. So we start looking at business and economics, we could see that these two things really do come together. And so make sure you remember law of supply and demand. We're going to be referring to that a lot in these case studies going forward. And this whole concept of how we calculate profit. All right. Have a good morning.